Silver is at $80, and the data sitting underneath that number right now is not something you want to scroll past. This is not a celebration. This is a status report on a market that is approaching a critical threshold, and the timeline is specific. OG John AG, one handle, X and YouTube. Can't be copied, it's mine, and they've tried. Same name, similar thumbnails, borrowed language. That's what happens when something is worth copying. But the copies always expose themselves. They need your money. A course, a signal, a private group, a mentorship. That's the tell. I don't sell anything. No signals, no mentorship, no member videos. That absence is how you know you're at the source code. Let's get into it. COMEX registered silver, the metal sitting in vaults that is warrant issued and actually available for physical delivery against futures contracts, is now 88.19 million ounces. That number keeps falling. March open interest converted to ounces sits at roughly 240 million. The gap between those two numbers is the implied deficit. When you divide that deficit by the daily rate of open interest reduction through the roll process, you get a timeline. At Thursday's roll pace of 30 million ounces per day, which was exactly where it needed to be, that timeline points to COMEX exhausting its registered silver around February 27th. Pull the COMEX vault reports yourself. The data is public. The ones who check primary sources already know this. Now, before anyone turns that into a doom headline, here is exactly what it means and what it does not mean. It does not mean a default happens next Friday. It means the roll must continue at pace, or physical inflows need to materialize, for the market to clear March without stress. Thursday, hit the target. One day. That's promising. But from April onward, this market runs into a structural shortage unless new silver enters COMEX vaults in meaningful quantity over the coming weeks. March is no longer the bottleneck. April is the next pressure point, and the ones paying attention are already watching those inflow numbers. Here is the data point that changes the framing entirely. There are still roughly 200 February contracts showing sticky open interest. Holders who, by every indication, are sitting there demanding physical settlement and waiting to receive the metal as fast as possible. In any normally functioning futures market, these positions clear without drama. The fact that clearing them has required this much effort tells you something about the physical appetite underneath this market right now. The week opened with plenty of noise. Social media was flooded with declarations that silver would crash because China was closed for the Lunar New Year. The theory was that with Asian buyers offline, the banks would have free rein to slam the price. And there is truth to that concern. Low liquidity periods like holidays do present a window where concentrated selling can move the market with less resistance. That is a real dynamic we have to respect. The holiday runs through the 24th, so we are still in the window. The thesis has not yet been proven or disproven. But here is what we have seen so far. We opened the week at $75.34 in the March futures contract on Monday. We sit at $80 today, Friday the 20th. The expected slam has not materialized in the first 5 days. Volatility actually dropped to its lowest level in weeks. Does that mean it cannot happen between tonight and Monday? No. The window is still open. But the alarm that was sounded, the certainty that this week would bring a crash, has not matched the price action we have seen through 5 trading days. The Hecla story is worth examining more closely. The claim spreading widely was that Hecla Mining realized prices above spot because COMEX is functionally dead, and customers were paying huge structural premiums to access silver in the fourth quarter. There is a more conventional explanation worth considering. When a miner sells concentrate to a smelter, the final silver price is typically set 1 to 3 months after delivery through what is called the quotational period. In a fast-rising market, that lag allows a miner to get paid at higher prices for metal that was already shipped earlier. The elevated realized price could simply reflect timing mechanics rather than a structural collapse in price discovery. But here is the thing. Both interpretations could coexist. Perhaps there is some element of tightness in the physical market showing up in those numbers. Perhaps it is mostly quotational timing. The data alone does not settle the debate. What matters is that the supply-demand setup in silver is genuinely broken. Prices are going significantly higher on fundamentals alone. But the ones who do their homework know the difference between what is confirmed and what is still speculation. Mixing them up weakens the real argument, but dismissing either possibility entirely closes the door on valuable discussion. Now let's move to Shanghai. Spot silver in China is at $86. Futures are at $88. The premium to Western markets is $6. China returns from its Lunar New Year holiday on the 24th. That buying resumes into a market where exchange inventories sit at decade-low levels, and the front-month contract continues showing backwardation, meaning prompt physical delivery commands a higher price than future delivery. Backwardation in a commodity market is the market screaming that it needs metal now, not later. That structure does not appear in markets where supply is comfortable. It appears when deliverable inventory is stressed, and buyers are competing for immediate access to physical metal. Zoom out from the metals for a moment, because the macro context just shifted. Fourth quarter GDP came in at 1.4% against an expectation of 3%. Final sales were even weaker at 1.2%. At the same time, core PCE inflation printed at 3%, its highest reading since November 2023 and above every forecast. Slower growth, stickier inflation. That combination removes the Fed's ability to cut rates as a relief valve and historically drives capital toward hard assets, as paper promises get questioned. You can verify those PCE and GDP numbers through the official Bureau of Economic Analysis release. Check it yourself. And then there is the Middle East. The U.S. has now assembled its largest military force in the region since the 2003 Iraq invasion. 2 aircraft carriers, 12 warships, fighter jets, including F-35s and F-22s, air defense systems. Prediction market odds of a U.S. strike on Iran by March 31st have surged to 61%, with over $322 million in volume traded on that outcome. Oil has responded, and when energy prices move on geopolitical risk, the broader inflation picture follows, which feeds directly back into the hard asset case. The ones who read James Rickards' Currency Wars understand this connection clearly. When geopolitical fragmentation accelerates, the financial warfare around commodities and currencies intensifies simultaneously. That book was written years ago. The playbook it described is the one running right now. One more data point worth filing. An unusual options position has accumulated on COMEX gold. Over 11,000 call contracts at strike prices ranging from $15,000 to $20,000 per ounce, expiring in December. Gold sits at $5,028 Western spot today. For those contracts to pay, gold would need to roughly triple. Large speculative bets like this appear periodically. Many expire worthless, and most do not carry informational value on their own. What makes this one worth noting is the context in which it appeared, added aggressively even as gold pulled back below 5,000 after peaking near 5,600 in late January. Someone was buying the dip on a catastrophic tail risk bet. That is a data point. It is not a prediction. Verify it and draw your own conclusions. Here is the honest bearish case, because intellectual honesty is what separates signal from noise. Iran and the US could reach a deal, removing the conflict premium entirely. GDP weakness could trigger broad risk-off selling that temporarily pulls metals alongside equities. The COMEX roll pace hitting its daily target once does not guarantee it holds through the remaining March settlement window. China's return from holiday could be more measured than anticipated, and silver's move through resistance can absolutely produce a consolidation or pullback before any continuation. None of these outcomes would invalidate the structural thesis, but they are real risks, and the ones who manage capital know that probability and certainty are not the same thing. This is financial warfare education. Position sizing and risk management are entirely your responsibility. Now for the tape readers, and I want to be precise that this is tape reading education and not a signal. Silver has taken out the previous Friday high from February 13th at $79, a level that had been acting as resistance. For price to demonstrate genuine continuation intent, rather than using this breakout as a distribution zone, it should not close back below the 3 a.m. New York local time hourly candle that reclaimed that high. That candle's low is the line. If price stays above it, structure is intact. Currently, on the lower time frames like the hourly chart, the structure does look good, but that is precisely why we need to be disciplined about what comes next. The resistance overhead is 81 to 82.25. That zone needs to be cleared aggressively and without excessive time spent consolidating inside it. If price lingers too long in that zone, it risks grinding momentum sideways and turning what should be continuation into distribution. The 150 exponential moving average on the hourly chart, which regular viewers already track, is now sitting below current price at $78. Former resistance becomes support. That EMA is now the first meaningful technical floor on any pullback. The question is straightforward. Does price push through 81 to 82 and continue toward 84 and beyond, or does it retrace to digest the move first? Drop your read in the comments. Bottom line on this week, the COMEX registered inventory continues its drawdown, with the roll pace hitting its required threshold for the first time, but that target must hold through final March settlement days. Sticky February contract holders are demanding physical delivery, not rolling. Shanghai is $6 above Western spot, heading into China's return from holiday on the 24th. The macro backdrop just confirmed stagflation-adjacent conditions with GDP missing hard and core PCE printing above expectations. Geopolitical risk has a specific calendar now with that 61% strike probability sitting in prediction markets. And silver has taken out a key resistance level and is now sitting at $80. The open question is not whether the structural thesis is intact. It is whether the COMEX inflow picture improves before April, or whether the market enters the next contract month with the same deficit math still running. Pull the vault data. Watch the daily registered inventory numbers. That is the live variable that will tell the real story before any headline does. Verify every piece of data I showed you. The COMEX reports are public. The COT positioning data is public. The macro releases are official government publications. The ones who check primary sources do not need me to tell them what to think. They already see it. Invest with logic, not hype. OG out and about.